Welcome to Smarten Up, the Tax Expert podcast, where we look at Australian tax issues from a practical and technical perspective. I'm Sally Preston, and today we're starting a mini-series on the CGT and negative gearing reforms that have now been enacted. So in this first episode, I want to break the reforms down into a simple sequence advisors can follow. Well, it's not really going to be that simple, but I'm going to do my best. But before we start, I want to just put a quick disclaimer. This podcast is general information only and it's not legal, tax, or financial advice. The rules discussed are complex, so advisors should still check the legislation, explanatory materials, ATO guidance, and the client-specific facts before giving advice. So now that that's out of the way. Now, as you know, for advisors, the headlines are not enough. It's not enough to just say the discount's gone or indexation is back. We sort of thought that it might be as simple as that, but of course it was never going to be. The real issue is that there are a number of changes that have happened. They're not all that easy to follow or to understand, but we're going to try and work our way through them so that you might have a better shot at it when it's your turn to have a look. Now, if you'd like to be able to find this new law that's been enacted, the main acts are the Treasury Law Amendment Act, Tax Reform Number 1, 2026, and the companion to it, the Income Tax Rates Amendment Act, Tax Reform Number 1, 2026. So most of the CGT changes are in Schedule 1 and Schedule 2 deals with the negative gearing changes. There's so much more to this than just a policy change. Nearly every step of our method statement of calculating a capital gain has been touched. The law looks at how the capital gain is classified, how losses are applied, how residential amounts are dealt with, whether indexation is available, and then we have to think about this minimum tax overlay of 30%. So because it is so complicated, for this episode, I'm going to use 5 steps. First, which is probably the easiest, we're going to identify the new rules and when they're relevant. In the second step, we're going to classify the gain so that we can understand what we need to do in that space. The third step is to apply the rules in the order that the law sets out. In the fourth step, we're going to check whether each category is preserved when we pass it through a trust or similar structure. And our last step is when we're going to look at what documentation and evidence we're going to need to have to support these capital gains tax calculations. So before we get into this, it's worth talking about the terminology. So I'm going to be using a few of these terms from the legislation, and whilst they can sound a little complicated, they are. But it's the terms that we're going to have to get used to. So we might as well introduce them early and give you a definition of them up front as best we can. So the key terms under the revised law, we've got a deferred gain. So a deferred gain, it's that part of the gain that's been accumulated or built up before 30 June 2027, which is our changeover or reset date. So it's brought to account later. It's a portion of the gain, and we've been told that there's still some sort of apportionment method we might be given access to, but by and large, it's more likely going to be a valuation at that date to determine how much of any capital gain accrued up until that date. That's called a deferred gain. Then we have our post-2027 gain, which is that part of a gain that builds up after 1 July 27. And that's worked out under the new rules, which is where we're going to be putting our indexation. Another term is a residential gain. So a gain connected with residential property or a residential component of an asset. So this matters because residential gains may interact with quarantine residential amounts and the negative gearing changes. So we'll get to that, the quarantined residential amounts as a definition too. Then we've got our non-residential gain. So it's gain connected with an asset that's not residential. Okay, so we're now splitting our assets into residential gains and non residential gains. So this might include things like listed shares, business assets, goodwill, commercial property, and it's going to depend on a little bit more clarification around that definition, but also the facts of the asset when it's sold. Quarantined residential amount. Okay, this is the tracked residential amount, which is essentially the amount of negatively geared portion of a residential property. So in the past, in negative gearing would be when expenses or deductions exceeded the income on that property. And we would use that negative gearing to offset other income. Now, as you know, that is gone. So I'll give you an example. You've got residential rent coming in at $20,000 a year, but the interest on the loan is $30,000 a year. Well, you're going to get a deduction for $20,000 only up to the amount of the income. So you're in a neutral position on that property, and that extra $10,000 gets tracked. So as an advisor, we're now going to have to track that amount, and that's called a quarantined residential amount. And it does come into play, to my surprise, in the capital gains tax calculation. I had thought it would be a third element of the cost base of the asset. No, that it couldn't be that simple. It's a lot more complicated than that. And so we're now tracking another thing for our clients, which is this quarantined residential amount. So that can only be used under this method statement against a residential gain. And we're going to talk through the method statement, but it's basically saying if you've got a gain, you can offset it. So you do get it back like a third element, but there's a bit of a kicker in this method statement that means that maybe you won't get it back at the time you thought. If it can't be used when you think, though, we're going to keep tracking it until we can use it. But it just might not be where you think so. Now, then we've got our indexation. We've heard the term indexation for some younger advisors. They never have applied it, but the concept of it's probably always been hanging around in your learnings along the way. We do have discount for some assets, just to add another layer of complexity. The method statement I'm talking about is the step-by-step calculation that's included in Section 102-5 of the Income Tax Assessment Act 1997, which has now been amended under these new rules. And that's where we used to look at that to follow it through. We would have a capital gain. We would then apply current year losses, then prior year losses. Then we would be able to discount it. Small business CGT gets applied, and we spit out the other end with our net capital gain figure for the year. So that method is what's changed. And that's one of the big changes that I probably didn't see coming. So then we've got our minimum tax to think about on capital gains, and that's the 30% minimum tax on capital gains. So even when we get through calculating our capital gain, we still have to then go to the new provisions which impose that minimum tax to then calculate it. So there's some key terms that are really going to set you up for when we work through some of these provisions. So, timing. When do the changes need to really hit your radar? Well, I think they need to hit your radar now because we're having conversations with clients, and I think that they're a little bit stressed about what it means. Some aren't probably stressed enough or thinking about it enough, but really the changeover date is 1 July 27. And that's the time when we're essentially drawing a line in the sand. There's a deemed or a notional disposal of the asset and then a reacquisition at that date. So we're really, which is why it's called a deferred amount, we're deferring that capital gain that we just calculated, carrying it forward until that asset is actually disposed of. So that's the key date. That's step one. Timing was the easy one. I said it was the easy step. Step two is the classification. Now, I've just been through those terms. So as you can hear from those terms, there's a lot of different ways we need to separate or classify our capital gains. So it's not as simple as you made a capital gain. Now we have to go who, what, why. How is it going to be classified? So questions like, did the gain build up before 1 July 27? 2027? And if so, could the discount apply to that portion? How much of it was post that date? And can indexation apply to that portion? Was it residential or non residential? So they're the classifications that we have to come up with. So that's the main shift. Our work papers we've previously used for capital gains get thrown out and we're designing a new set. So to go through some of the legislation for the people that do want to go and actually read it, which I recommend that you do, Division 102 is our method statement. Division 112 deals with the reset that happens 30 June 2027. This is this notional draw a line in the sand. Division 114, and these are all Income Tax Assessment Act 97. Division 114 deals with indexation. Division 115 deals with the discount rules. Division 119 and the rates legislation deal with the minimum tax overlay. Schedule 2 deals with negative gearing and residential loss changes. So we're in the situation now that two clients may say, I made a capital gain, and we need to work through each gain very differently because they're going to have different fact patterns. So for individuals, trusts and partnership, the 50% discount in Division 115 will no longer be available for many post 1 July 27 gains. Of course, we've got some carve out because why wouldn't we? We need to keep it complicated to keep us in a job. So the next main question is what happens to assets already held? And because we've got this reset, so in broad terms, we draw a line in the sand at 30 June 27 to assets held, and a gain built up to that time is called our deferred amount. So we're going to have to calculate that. Now, if you've had a significant gain up to that date and you don't think the growth in the value of the asset is going to be linear, then you might really want to get that valued. We haven't got any guidance as yet on what that valuation method could be, whether it's simply we need to be employing valuers or whether there's going to be a little bit more leniency about valuation. If it means a lot to you or if it's worth a lot, a valuation is probably where you want to go. Otherwise, you'll have the opportunity to apply an alternate method, which we have not seen, which I'm assuming will be some form of days apportionment, but then I've been wrong about many things since the budget day. So the use of the word deferred is the built up gain up to that date, but brought to account later. So that's why we need to look past discounts gone, indexations in, because everything's changed. All right. Our next step, other than that date, is to classify that gain. So what was it? We've got 4 buckets: deferred, non residential gains, deferred, residential gains. Now, think deferred being discount, might be the easiest way. Pre 2027 gains is deferred. Non residential and residential. Then we've got post that date, residential, non residential. So rather than 1 capital gain, we've got 4. So if you get the capital gain to the wrong bucket, your calculation is going to go wrong. So that's the classification exercise we're going to be digging. And we always dig for capital gains because they're pretty important and usually a pretty large amount. But in some cases, the asset itself is going to be complicated, let alone this changeover date. Our step 3 is where it really gets into the nitty gritty. And that's where we have to apply the rules in the right order. So in the past, we would have a capital gain. We would apply current year capital losses. We would apply prior year capital losses. We would then discount. We would then apply small business CGT and then have a net capital gain. In that, we got to choose where we applied our capital losses. We applied them to a non-discount capital gain first because it simply meant less tax. And we got to choose that. And that was always nice. So preserve your discount, apply the losses so you get the maximum benefit of the losses against the gain that's not discountable, and off you go. We don't have that luxury anymore. There is no choice in this method statement. It's quite prescriptive. So first, identify the capital gains for the year and put them into the right categories. And that's before losses or concessions are applied. We need to put them into their buckets. So are they deferred or post gains? Are they residential or are they non-residential? And which element of each gain falls into where? Second, we then need to apply the current year losses in the order specified under the law. So you don't just choose the most favourable. Basically, the legislation tells us which ones have to be reduced first. And that's the same for our carry forward capital losses. So we don't get to optimise, we have to just do what we're told. I will tell you, it's going to hit your discounted gains first. So your discount portion of the gain, if you've got losses, could get soaked up very quickly and be a completely different calculation than if that wasn't the case. So when you get to the end of those 2 or 3 steps of applying losses, bucketing them, applying losses against the right categories, and come out the other side, you're then going to deal with quarantined residential amounts. Now remember, they're the negative gearing amounts you haven't been able to claim because of limitation on negative gearing now. And they've been accumulating. So if that $10,000 of interest wasn't deducted year on year and that kept accruing, and 5 years later, you've got $50,000. Now that's not indexed. Rude, but it's not. So that then can get applied, but only against residential gains. Now remember, we've got an order of applying losses. So it could be that if you do have a loss, you could have soaked up all your residential gains by that loss, even to the point that these carry forward quarantine residential amounts may not be able to be applied against the asset to which they're related. You may be carrying them forward until you get an opportunity to use them. Now, if you don't buy another asset of the same nature to make a residential gain, you're never going to get it. So that was a real shock. But you really need to be aware of that. And that's going to require a little bit of strategic thinking on behalf of your clients. And then you get to apply any discount if there's a discount gain left. And then you get to apply the indexation, assuming that that's the bulk of the gain that's remaining because we've used the discount amounts first against any losses. And that's the method statement. Then we've got our small business CGT concessions. And then the final test. You get through that method statement and then you need to apply the minimum overlay of tax. So then you need to fast forward into the rules around the minimum 30% tax. So even if you've got a favorable result, you're going to get to the end of this and then have to turn a few pages or more to find that and apply those rules. So this method statement is a lot more than what we've ever seen. And I think that that's what the important part of this podcast episode I'd like you to take away is that we really need to be thinking if there's a choice in making a gain for clients, we really need to look at it in advance. And if you're a client out there listening, you really need to be communicating with your accountant and paying them for their brains and their wisdom about some timing of some gains. All right. Step 4. So say there is a gain in a trust. Now, if you think you've got all these different categories and then at the end of the year, you need to make a trust distribution. Otherwise, the trustee is going to pay tax at the top marginal rate. But if we think about just simply flowing a distribution out of a trust of a capital gain, we have streaming rules. But more importantly is we have a trust resolution as to where the distributions go. So we do have to think about what we're distributing, who to, and probably being a whole lot more specific in our trust resolutions about how the distribution is being made. So have I drafted a resolution taking these into account or contemplated it yet? No, it's still fairly new in, but you need to keep in the back of your mind saying simply in a resolution that dad receives a capital gain may not be enough information to then understand what else is being applied. So losses indexation, you have to have done it all. And I suspect that we're going to be naming assets a lot more frequently in a capital gain so that we can understand what we've distributed and what it relates to. So let me give you a simple ordering example. So how these rules will work. Let's assume an individual sells listed shares and a residential rental property after 1 July 2027. Now, in an earlier year, but after 1 July 27, the same taxpayer had already disposed of another residential property. Now, this property was not eligible for negative gearing. So it left the taxpayer with some quarantined residential amounts. Now, remember, they are the amounts that couldn't be deducted because the negative gearing changes. But worse than that, the poor taxpayer made a capital loss when they sold it. So not only did they miss out on some negative gearing, they also made a capital loss. So assume that that's the case. We're carrying those forward. Now, we currently have the listed shares and a residential rental property to sell. So both have been held for more than 12 months. And so therefore, under the old CGT rules, they would have both been able to access a discount. Let's assume the share sale produces a $40,000 capital gain. The residential rental property produces 120,000 gain. But let's split that into two different periods. So let's say $70,000 of that gain was made pre 1 July 27. So it's in that discount period. And 50,000 was made after that time. So we're going to split our residential rental just to show how this method statement works. So, and we've still got from our earlier residential property disposal, we've got 30,000 in losses carry forward and a $20,000 of quarantined residential amounts. So if these new rules had not come in, we've got a best case that we're going to run through. So the taxpayer would have started up by adding up his capital gains. So if we had 120,000 on the residential rental, we didn't care. And we haven't cared about when it was made, it was a discounted gain. We had 40,000 on a discounted sale of shares. So we've got 160,000, but because we had carry forward losses, we had to apply those. So now our gain's gone from 160,000 down to 130,000. Now they're both able to access the discount. So we've got a capital gain remaining after we work through the original method statement of $65,000. Now we're going to ignore indexation, we're ignoring everything else, but that's a pretty simple current state of play. So under the new approach, we're going to have a different way that we simply apply those rules. So let's go through the method statement. Step one, we've got to keep the gains separate. So there's a $40,000, and we're going to assume the share sale was all post 2027 changes. And because they're shares, it's a non-residential gain. So that's going to sit in one bucket. It's a post and it's a non-residential. We've then got of our property, we've got part of it being residential, and I'll call it the deferred residential gain, which is the language used. But let's think of it as the discount portion, the portion eligible for discount. Then we've got 50,000 after that time that's not eligible for discount. So we've got that into two different things. So we've put them in our buckets. That's the first thing we've got to do. Then we've got to apply our losses. Now we've made no losses this year. So that's okay. So we move forward then and we look at the carry forward capital losses to apply. Now, there's rules around how to apply them. We apply the 30,000 carry forward capital losses in the order required by the method statement. So on these simplified assumptions, it reduces the deferred residential gain first. So anything that had a discount available to it gets reduced by those losses. So that means we had 70,000 eligible discount capital gain on our property. We've got to reduce it by the losses, which was 30,000. So now we've only got 40,000 left of that gain. It's good that we got to use our losses, but it's not in the most optimal way. We get a chance to see if we can apply our quarantined residential amounts. Now, our quarantined residential amounts are our non-deductible portion of our negative gearing amount. So we're not negative gearing. It's our rental property deductions we couldn't take. So then they get to be applied, but it has to be applied to only reduce a residential gain. So first we have to attach it to our deferred, our discount, residential gain. Now we had $20,000 of those. So that's going to reduce that from $40,000 to $20,000. So now our discount gain has been reduced even further. And anything that we couldn't use in those residential would just keep getting carried forward, but we could use them. So then the remaining Deferred residential gain in the discount portion, which is not much left, is added up, and then we've got to add our gain on our sale of shares, which is not being reduced by losses, not being reduced by that quarantined residential amount. So we've got our original 40,000, we've got our post law change gain on our property, which is still completely intact of 50,000, and we've only got 10,000 left of our discounted portion of that property. So overall our net capital gain has been reduced down to 100,000. So if we compare this to where we came from under the old rules, it's quite a big difference. So under the old rules, the best case scenario when we went through the old method statement was we would have a net capital gain of 65,000. But under these ordering rules and the way that we apply the discounting and how we have to apply the losses, we're left with a net capital gain of 100,000. And so it's nothing to do with the change in the underlying assets, same asset, different tax laws and the different methods that we have to use. Now, it's going to be more complicated when the assets that we're applying these rules to are not as simple as listed shares and are not as simple as residential property. Because remember, the CGT method statement applies to every capital gain. And you can make a capital gain not just from disposing of an asset, but from doing a lot of other things. And so I haven't turned my mind in detail as to what this pre law change and post law change means in some other scenarios, but I suspect we're going to end up with a really bad result or a result that we can't actually get the answer to by the way this law is drafted. And so stay tuned. I suspect that we're going to have to get a lot more guidance because I think when we get to work through the provisions, there's going to be a lot of issues with this changeover date and the way this is phrased. Um, that's the big impact of calculating a capital gain under the new rules. So the final step I wanted to talk about, which is step 5, which is building the evidence and reviewing the documentation you've got. So this is your file that you need to keep. And this is where the calculation and keeping the documentation around it is going to be increased. So, asset registers for any of the assets that your clients hold are going to need to be a bit more thorough. We've always looked at acquisition date, but we're going to need to think about the different categories of asset. Look, imagine if a residential property went from being residential to not residential. I haven't thought about that, about what that means. And if you applied those rules, we're going to have to separate and do valuations or some sort of apportionment of gains at this changeover period of 1 July 27. So what we're going to need to do is have some comprehensive work papers, some substantiation for valuations used. We have not got guidance yet on whether we're going to be following the original guidance on valuations, whether we're going to have some sort of concessional ability to value things. But we're also going to need to really model out what every capital gain is or really document how it's been applied. So if we think back to the step on looking at trusts, well, it's going to be more complicated. So if we're passing a gain or a trust makes a gain, then we are going to have to really have rigorous documents for our resolutions, for our distributions. So the documentation is not getting less for your accountants and lawyers. It's going to be more. And as you know, in other matters that we're facing with compliance activity from the ATO, it's all about the documentation, the substantiation. So you really need to think about that. But I want to do a quick recap before we wrap up this session because the next one we're going to delve into a different area of these reforms. So let's think about where we've been. We've talked about the timing. Does the CGT event happen before or after 1 July 27? So was the asset held at this sort of reset date? Number 2, we talked about classification. So blowing our minds about having one gain now turning into being classified into 4 potential buckets. Then we've got the ordering, which is the method statement, and that is super complicated. Then you've got to think about if it's in a trust, how that distribution is going to occur, what your wording is, what your trust deed says. And then the final step was the evidence and making sure that we have a robust file to document the pre, the post, the residential, the non residential. And we haven't really even got to talking about the minimum 30% tax, because I suspect that's going to be the topic in one of the next ones. So the main takeaway is there's a bit of homework to do between now and 1 July 27. So if you remember nothing else from this episode, remember this. Do not start with one capital gain and work through the method statement like we used to do. What we need to do is really look at what happened, what it is, get the information from the client, and then work through the methodology. And so, if you understand that there's a lot more complexity, then that might help you when you're coming to engage with your clients. It might help you when you come to quoting capital gains and calculating those capital gains and advising on them. So, in episode 2, the next episode, we're going to move from this calculation framework into things like valuation, what's residential, quarantined residential losses. We're going to talk a little bit more about those, and what that indexation is going to look like. And then the next episode, we're going to talk about trusts, business structures, and that minimum tax overlay. And of course, we're getting further guidance on some tax law changes for trusts overall. Whilst we don't have any legislation, I'm sure when we get it, we'll be doing a podcast on that. I've got a lot of other topics lined up for you, but thanks for listening to Smarten Up, the Tax Expert podcast. My name is Sally Preston, and I'm looking forward to talking to you on the next episode.